Guys, this is Dow Houston with Dow Houston Exchange Companies. What I want to talk about today is financing, and this is part 2 of reverse exchanges, by the way, but is how to finance the reverse exchange. And why, you may say, well, why do we need to finance it? And I want you to think about this. In a traditional forward-looking deferred exchange, you've got cash on the table and cash at work, because what you've done is you've sold the relinquished property, converted that into cash that the intermediary is now holding to purchase replacement property. However, in a reverse exchange, you don't have that ability because you're still holding the relinquished property. It has not been converted to cash yet. So there's got to be a capital influx into this transaction in some way. There's traditionally 3 ways to do that. The first way, and by far the simplest way, is for the taxpayer to make a loan to the accommodator. So if it's $1 million purchase and the taxpayer has access to $1 million, they would loan it to the accommodator. On the date of closing, to secure that purchase price, the accommodator would give a promissory note and a mortgage securing that property. Now, most accommodators will do that on a non-recourse basis. That means there's not personal liability on that note back to the accommodator. They're not real estate investors. They're not investors of any kind. They are merely accommodating the taxpayer in this transaction. So that is putting the capital into this exchange as it needs to be, okay? Option number 2 is if the taxpayer doesn't have access to those funds out of their general account or investments, then a lot of times they will go to their lender. They may have other property that may have equity in it, and they will take out a loan. They will then get that cash proceeds, make that available to the accommodator, and again, you're securing that the very same way, in that the accommodator is giving a promissory note on non-recourse basis and a mortgage on non-recourse basis back to the taxpayer to secure this transaction during the 180-day exchange period, okay? Finally, this is the most difficult. We do it, but yet it is more difficult, and that is to have the taxpayer make arrangements with its lender to lend the accommodator the funds on a non-recourse basis, with the accommodator giving the lender back a promissory note and a mortgage on the property. Now, obviously, lenders will be hesitant to do that. They've generally not worked with that accommodator before. And so to give that accommodator, or give that lender the security they need, that loan is guaranteed by the taxpayer, okay? So traditionally 3 ways to do it. A direct loan from the taxpayer to the accommodator with a mortgage and promissory note. Second, the taxpayer obtains a loan on other assets to make cash available to the accommodator. And third, to a loan from the taxpayer's lender with a guarantee from the taxpayer, and of course the accommodator giving a mortgage and promissory note to the lender. Hope you enjoyed this. Hope it's more complex than this. This is just an overview to help you kind of see through this. I hope you find this content useful. Don't hesitate to call us, Dow Houston, at Dow Houston Exchange Companies.